Hello and welcome to Halftime Talk, the weekly show where we take a slightly deeper dive into the trends that are impacting the energy markets globally. And I think there's probably nothing more significant this week than where are tank storage filling up all over the world. And we probably have no better person to have this conversation with today than one of the top brokers in the United States, Mr. Ernie Barsamian, CEO of the Tank Tiger, a great name. We like that. Thanks, Ernie, for joining us.
Thanks for having me. Looking forward to the discussion.
There's no doubt that storage has been, there's probably my 10-year-old son could start talking about Contango and storage. It's become so central to the narrative in the last few weeks. But what happens when we actually get full, and will indeed we do fill up tanks globally?
Well, I've gone on record for a number of years saying the world's never going to run out of storage. And so far I have been correct. But having said that, I think these are unprecedented times.
You probably said before that we'd never see negative oil prices.
Right, that's another topic. But at the end of the day, I think the reason why oil prices went negative, it was a price discovery moment, and I think the same thing ultimately is going to happen with oil storage. There will be a price discovery moment or a period where the signals that we get from pricing is going to either reduce production, which it already has, or generate the need for more storage somehow, which it will. If it behooves you to have more storage, people will find a way to do it. Capitalism is a wonderful thing sometimes. So, but then it's always darkest before the dawn. Certainly there was a period, I remember very vividly, it was Sunday night, March 8th, right after the Saudi announcement. I received lots of interest for available storage that we had, and that was taken out very rapidly by the big astute trading houses and refiners who were interested in securing the storage. And essentially they knew that Contango was going to be there for an extended period. And most of the really good storage that everybody wants all the time got taken out very quickly. And that was actually early before the middle of March.
And so, is that storage booked but still not filled, or how does the profile look like?
Well, the big storage hubs, obviously, on the crude side, and I'm talking about North America and South America now, and the Caribbean. The Caribs has a substantial amount of storage, in the tens of millions of barrels. Houston obviously does as well, but Cushing, the 100 million barrel position there, is, since that's the NYMEX delivery point, that's where everybody wants to have it, so they could take advantage of the cash and carry situation in the easiest manner, essentially. But the Contango then will feed on itself. Once it's established, the storage becomes more and more rare, and it's more and more desired. And then as a result, that's what creates the Contango curve to sustain itself until that inventory overhang gets pulled down.
But you don't think we'll actually get to full storage? Goldman Sachs over the last few days have predicted that they expect full tank top, as they call it, by mid-May.
Again, that really can't happen because we're never going to see oil on the ground. Essentially, what will happen is wells will shut in because it's not profitable for them to deliver barrels at prices that don't cover their costs, and refineries aren't going to run when it doesn't make sense for them to produce product. So again, it all kind of slows to a halt and doesn't force you to go over the tops on tanks. Essentially, the oil stops moving, really, more than anything.
It's been a little bit surprising in a sense that on the production side that we haven't seen quicker response on shutting in production. People, obviously we had the sort of market share war with Saudi and Russia, but it's still full steam over the cliff.
Yeah, it's a lot like trying to stop the Titanic when it's headed for the iceberg. I think, the producers, the wells are already, flowing. And even at very low prices, you can still, you still want to generate the cash, even though you're losing money incrementally to cover your debt service. And that's really, what has to happen is it becomes a game of chicken or a survivor's game where those that have the highly leveraged balance sheets essentially have to stop. And maybe that creates an opportunity where oil prices, a floor is established, and then those prices start to firm up a little bit. so the survivors then can sustain themselves a little bit longer.
Are you seeing demand on your clients looking for any particular products, any particular crudes that they're looking to store?
No, I don't think so. It's really, I think, when you look at the Contango play, it's essentially, what can I get that's the cheapest? I mean, I think ultimately that's where the value is created. I mean, you can look at the WTI price, but there's so many types of crudes that are now imprisoned that are trading well below the WTI price that if you find a place to store the barrels, that Contango becomes even more rewarding for people that can establish that play. Of course, it's logistically more challenging to go get the crude and then find a place to put it and then certainly ultimately sell it. But I think all of those costs are baked in when they decide it's an opportunity to do that Contango play.
What about refinery run cuts versus demand recovery? How do you see those two working together?
Well, it's kind of like that saying the thigh bone's connected to the ham bone is connected to the rib bone. Really, the refinery, the lack of demand from the jet fuel, which actually happened in January, and then obviously led to the gasoline curtailment with the self-isolation. My car's been in the driveway for 2 weeks. I haven't started it. That reminds me. But essentially, that forces the refineries then, since there is no product storage opportunities to continue to refine product and then store it, they've had to cut their crude runs, and then that of course backs up the crude that wanted to get to the refinery. So ultimately, until we see that restoration of demand, the refineries are not going to respond. And I think interestingly enough, when all this comes to pass, hopefully someday, we're going to see a big problem with product availability because people are going to, I think, respond to demand pretty much on the same signals. So we're going to see that increase rapidly. And as a result, I don't think the refineries are going to necessarily be ready to provide that product. So we're going to, crazy enough as it seems, my prediction is we're going to see a big run up on product prices and refining margins. When that is, I don't know, but I think that will happen.
In terms of storage rates, we're seeing a lot of renewals come up in the second half of 2020. Do you think they will be closer to spot price that we're seeing at the moment?
Well, what I've counseled the terminals on when I speak to them is that it's really easy to take advantage of the Contango and then jack up the price you charge for storage for traders that want to get in and utilize your tanks, because they always know if your price is too rich and the trader doesn't want to do it, they'll step away and someone else will step in anyway. So the terminal tends to benefit and get a larger percentage, a lion's share of the Contango profitability when people do these storage plays. But what I've told them to do is look, you want to establish relationships with these people. So if a trader, for example, wanted to take out storage for 12 months, instead of jacking up the price and doubling it, I would suggest, hey, why don't you see if they want to do 18 months at the same price or for a little bit more, do 2 years. And that way, ultimately the backwardation will come back. And instead of having to fight for customers again, at least you get a coupon for your tanks that are not being utilized.
What's the current rates versus spot in the second half of 2020?
For storage, it's really, really difficult to give you an answer. It's just a hypothetical since there really isn't any storage to be contracted. Again, I think that it's not a very liquid mechanism that you could attribute to Contango. It's really a function of relationships and the reward that some terminals want to give customers that have been longstanding customers, so they'll make sure they get the first dibs on available storage. So yeah, the terminals are going to get more. I would say prices have at least doubled for storage, that's for sure. Maybe even tripled in some cases. But at the end of the day, I think the terminals are looking for utilization because when they're getting $0 a barrel for their tank in a backwardated market, they have a long memory and they know to get utilization when you can.
Before we leave storage on that, I just wanted to move to talk a little bit about the USO, the United States Oil ETF, which your quote actually that you posted, I think it was on LinkedIn, that I really enjoyed, and the flip-flops and the Bermuda shorts and the amateurs basically playing the grown-ups game. I'd be very interested to hear your views on how you see the USO playing out now. Obviously, in these coming days, we're expecting a rollover to the July contract, also with the Goldman Sachs ETF as well. What's your view on that subject?
Well, first of all, from a storage standpoint, again, most of the excitement that I saw was in March. The excitement everybody saw in the news was when oil prices went negative in the third week of April. Look, those traders, even though they're wearing cargo shorts and flip-flops, they're infinitely smarter than I am. They talk a language I could hardly begin to understand. But on the same side, maybe they don't fully understand what goes on when you take physical barrels and when you're forced to take them. And I think that may have been, obviously, I'm sure they didn't want to get caught short like they did. Maybe that's a lesson that potentially they learned. But what happened, essentially, they were in the open interest was so large relative to the amount of physical barrels that actually get transacted. I mean, in the fact that they just waited too long to try to, unwind their positions. And that's really, we saw that free fall in pricing. And
now they seem to be doing the opposite. I don't know, lessons learned. Now they're consolidating their rollover into a few short days in the next few days.
Yeah, well, it looks like the open interest is a little bit lower, for the June contract than it was in May. But again, I'm not an analyst on that end at all. I prefer to get my hands dirty with the physical barrels. One time I tried to buy USO because I thought oil prices were cheap, and the Contango kept rolling, and all I did was lose money. So that was the last thing I know about USO. Probably the last things I ever want to know about USO.
Well, their price is dropping quite sharply, and they're having to split shares and so on. Do you think there's any chance it could go to zero?
I don't follow it closely. I mean, nothing will surprise me anymore.
Yeah, it's one of those
Some
things.
Value, and I'm sure they don't have all the contracts for the front month, but of course, if prices go negative, and they can't get out of those positions, then that'll pull away on a lot of the value of the asset.
I mean, we are seeing another strange kind of development, and there's no shortage of unprecedented, if you like, in the market at the moment. But the difference between the futures and the physical, for example, we're seeing the physical Urals that say up $5 a barrel, while the futures are cratering. Any thoughts about why that would be?
I think we have a divergence now, and yes, when contract expires, I mean, futures matches physical, but maybe prior to that, we're talking about two completely separate markets. And I mean, I don't know if certainly when you look at the amount of open interest in the NYMEX futures contract, it's almost like two different games being played.
They tend to converge, as we found out last week, at the last day of contract. Physical futures come crashing head on. I wonder if they'll do so again. Looking at this current sort of significant, I don't know, want to use the language, super contango, there must be some consideration for building of new tankage. What's your outlook for that, and any particular crude products? What's your outlook for that?
Well, certainly, I think that's a good point. Clearly, we're not going to be out of this contango situation until we see a reduction of inventory, and we're not going to see a reduction of inventory until we see a significant increase in demand. And we're not, I think OPEC Plus already went to the well and announced their cutback, but that cutback isn't even below where they were when this mess all started. So it's going to be a long walk home, I guess, to get those inventories down and to get the contango to start to behave in a more normal fashion. So ultimately, like I said, I think, we're going to see these contangos roll from month to month to month. So, I think what terminals are looking at right now, and I'm working very closely with them, is if they have tanks that had been historically out of service because they had been underutilized, if you could patch them together and get them going in 2 or 3 months, I'm pretty confident that contango is going to be there in 3 months. And I've been talking to some traders, said, look, even though the market curve isn't out there for you to take a 6-month deal starting 4 or 5 months from now, if you knew that contango was going to be there 4 or 5 months from now, would it make sense for you to take that storage? And I think the answer is definitely yes. So that's going to be the first, I guess, wave of available tankage that comes in. The tankage that actually exists that's out of service, and that's not a small amount of tankage. And then on top of that, we have
what size would it be? Would you have any sense? Would you put a scale on it?
I can't speak. They're there. I mean, there are millions of barrels. I mean, certainly. I mean, that I know about, and I'm sure there's a lot more that I don't know about. We're talking.
Would that also include pipeline?
Definitely. You know, on top of that, there's caverns. I mean, we just listed 2 new cavern facilities on our website today, so that's going to generate some interest on the crude side. Yeah, and the pipes that and the gathering systems, which certainly are not going to be utilized as much if this flat price stays low. That's available storage too. So, you know, any way people can monetize their assets, at least over the short term, they're going to look for these storage opportunities to find customers they may not know about.
Would you expect, in terms of a possible new build program, that would focus around any particular products?
Well, we're certainly, it's funny, you know, we're under tanked on the gasoline side, you know, because typically what traders like to do in the wintertime is to store gasoline with the low RVP when that's required in the summer driving season. And, you know, a lot of that gasoline was sitting in tanks when all this demand reduction happened. So there really wasn't a lot of available gasoline for the refineries to put the extra gasoline that they were making. It was kind of problems. But, you know, certainly in New York Harbor, that's a place where people always want to have gasoline and diesel storage because that's the NYMEX hub. If you have inventory there, you always have a buyer. But, you know, any other waterborne location, generally those are the locations that, you know, incremental tankage. And we're aware of some projects that are going on where new tankage is being built in New Orleans and in the Gulf Coast. Certainly all the programs that are going on in Corpus Christi when exporting seemed like a really good idea at the time, those are still going forward.
Do you have any expectations that there could be any policies about there's talk about, you know, blocking imports into the US, given the sort of situation with the oil industry in the US and all the politics around that?
Yeah, putting tariffs on. Look, I'm a free marketeer, so I'll never be on record as saying that I think that's a good idea. I mean, ultimately, if you restrict imports into the US, you're essentially, you know, making it more expensive for refiners to operate. Someone's going to get hurt as a result of that. You know, what really has to happen is, you know, the free market has to do what it has to do. I don't think people want, you know, all the oil being in a few hands. Directionally, that's what I guess would happen if there was an extended period of really low prices that forced some of the producers to shut down and go bankrupt and essentially be scooped up by the bigger players. It's really, you know, it's not really it's un-American, I guess, to have influence free.
There's a lot of un-American things happening at the moment, like a paycheck coming from Donald Trump into your bank account.
Well, I mean, my son got one, so he's not too unhappy about that.
Yeah, I'm sure. Send him my address. I'll take it happily. Just to wrap up, what's your thoughts about the driving season? Obviously, it's a huge demand window in the US calendar. Is it going to happen this year? What's the ramifications if it doesn't?
Well, a lot of that is, I think, you know, transportation, I think, is 70% of all the oil consumption in the United States anyway. A lot of that has to do with commuting. So I think we're not going to see, you know, we've now been isolating for 6 weeks. And as far as I know, you know, all these people working remotely from home are functioning fairly normally. So there's going to be some thinking about, well, we need to have an office. Why? Or I need to
pay that very expensive rates in New York City. Why?
Yeah. I need to commute 2 hours a day each way. Why? So certainly there's going to be some long-term paradigm shifts, I think. But look, people want to get outside. It's starting to get nice out. They're going to be driving, and we're coming off of zero essentially as far as, you know, gasoline consumption. So we're going to see that go up in a hurry.
So just to come back to where we started, tanks won't get full, but they will be fully booked. Is that your essential point?
Yeah, the storage that can leap tall buildings in a single bound and that's faster than a speeding bullet, you know, the ones that everybody wants, that's all been contracted. It's not full yet. Now, there's always a secondary market. I mean, the people that oversubscribe to the tankage that they wanted and maybe not necessarily utilized, they can always lease that out to others that want to get in. And that's actually one of the functions of our company. We do that. We're a clearinghouse and we connect people looking for storage with people that have it. So we'll be well aware of that activity taking place. But yeah, that's a correct statement. Pretty much all the storage that everybody wants has been contracted. It's not quite full yet. We're going to be watching that really closely from week to week to week to see where those inventory builds are occurring.
Well, listen, Ernie, thank you so much for being on the halftime talk this week. Your insights are very valuable, and I'm sure all of our audience will be very interested to hear those insights. So thank you so much, Ernie Barsamian, CEO of the Tank Tiger, based in Pennsylvania in the US. And I believe I can't hang up without saying bench presses over 300 pounds.
Yep.
That's a massive achievement for a 21-year-old, never mind somebody who's 25. So congrats on that.
Well, anybody can do that if they try. I hope everybody stays safe out there, and thanks for having me.
Thank you, Ernie. All the best.